Long-term Treasury market. In our prior conversation, we discussed the prevailing misinterpretations or a lack of attention to key aspects of the Treasury market, and I'd like to delve into those important elements today. I've been studying currencies and currency life cycles since 1987, and the Treasury market, which serves as the bedrock of the global financial system and the primary source of currency creation, is currently exhibiting extreme volatility. The Treasury market has become unhinged, and significant players such as government and central bank entities, historically responsible for stabilizing it, are withdrawing. Simultaneously, the U.S. government is issuing substantial new debt. But the market's response has been underwhelming. The replacement buyers for these steady hands are largely institutional investors, such as those managing mutual funds, pensions, 401ks, ETFs, and annuities. These institutions are effectively handling the public's money and presenting it as an opportunity for high returns. However, the general public may not fully grasp the implications of inflation on their investments. Inflation is a complex concept, but its rise suggests a loss of purchasing power for the US dollar, which is indicative of a more profound crisis than what most people perceive. Instead of a conventional recession, we may be heading towards a hyperinflationary depression, primarily because there are few buyers in the Treasury market other than individual investors. Can they uphold market stability? It seems unlikely. To summarize, the Treasury market is undergoing significant dysfunction. Market dysfunction. We are witnessing a shift from traditional Treasury holders, such as sovereigns, to retail investors and various managed funds, including mutual funds and hedge funds. This transition from smart money to less sophisticated retail investors is amplifying the problem. The underlying issue here is oversupply with a lack of demand in the Treasury market. Recent reports, like one from the Financial Times on October 9th, allude to concerns about solvency and political stability, raising fears of a potential missed bond repayment. This underscores the fragility of the Treasury market. In response, the government may resort to easing monetary policy, printing more currency, which would lead to the inflationary wave we discussed earlier. Treasury holders would be at risk. Foundation of the system in danger. The Treasury market serves as the foundation of the global financial system because the US dollar has been the world's primary reserve currency for decades. However, this status has eroded since 2000, and with the shift in international relations and the rise of other currencies, such as the euro, the dollar's role as the dominant global currency is diminishing. The public may not fully grasp this, but it has profound implications for our financial system. The Federal Reserve's recent implementation of the FedNow system, which enables 24/7 instant payments, underscores the ongoing shift towards digital currencies. Every U.S. citizen now has an account with the Fed, whether they realize it or not. This paves the way for the potential introduction of Central Bank Digital Currencies, CBDCs, offering new solutions to address economic challenges. Expansion of global conflict. Regarding global conflicts and the Middle East, we are witnessing a complex and protracted situation. The United States has invested significant resources in Ukraine and is now engaged in a second proxy war in the Middle East. It's challenging to predict the duration and outcome of these conflicts. The U.S. may face difficulties restarting its war machine, and while there is a restarting of industries, it is a lengthy process. The shifting global power balance may lead to unforeseen developments, and it's challenging to predict how these conflicts will evolve. In summary, the Treasury market faces challenges, and global conflicts are complex and evolving. The landscape is changing, and we must adapt to these shifts and uncertainties.